My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'm building my friends. I'm trying to make you some money. My job, not just to entertain, put it in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. I said it before. I'm going to say it again. You want companies that make things and do stuff at a profit, then return some of those profits to you, the shareholder, with stocks that sell at reasonable valuations. Now, you might think that's a narrow funnel, but on days like today, you can save yourself a lot of heartache, and I mean this kind of heartache, by sticking with what works. Today, we saw the hazards of violating these new rules. With the Dow rallying 250 points, filled with this, right? S&P edged down 0.06%, kind of a balance. And the NASDAQ, where a ton of companies that aren't profitable and their stocks are expensive, will get out. I'm not going to give you anything, tumble 1.22%. First, we have the debacle of the year today, Netflix, which reported a stunningly bad quarter with an outright net loss of 200,000 subscribers when analysts were looking for 2.5 million sub increases. We're going to go over this many times. Take this. Netflix itself made mistakes. They haven't been able to monetize the 100 million users who basically borrowed the service from friends or relatives. They've ignored the competition. They're worried about tech, giant production costs, saturation. But at the end of the day, Netflix is a stock that's valued based on its subscriber addition, not its earnings. As long as it kept signing up new people, Wall Street was happy to ignore the actual price to earnings multiple of the cost of the stock. Once that sign-up engine sputtered, though, then Netflix became just another stock that doesn't fit the market's new mantra. We have no idea what we should pay for a no-growth company that now sells for an unreasonable price. Worse, maybe we have to put it in the bucket of pandemic pull-through plays. Oh, my, is it another Peloton? Don't tell me it's a DocuSign. Could it be a Zoom? Yeah, that's how a mega-cap stock loses 35% of its value in a day. Well, more on that later. Let's contrast that immediately, though, with a stock that we bought for the Chapel Trust today in response to the action in Netflix, Walt Disney. Because Disney has its own streaming service, it was treated as a pathetic fellow traveler to Netflix. So its stock plunged 5.5%, by the way, to a 52-week low. Now, we know Disney's spending a lot of money on content, but we know that the stock isn't classically expensive because the current round of spending on the streaming service is temporary. Nevertheless, unlike Netflix and its one-hit wonders, Disney has a massive, lucrative theme park complex, along with a stable of iconic franchises that can be extended from here to eternity. Netflix is a building. Disney's a theme park of brands with unbelievable IP that can be used for any ride. As for Netflix, let's just say I refuse to go on a Squid Game-themed roller coaster. I know ESPN is widely considered to be an endangered species, but the ESPN Plus streaming service, I'm calling that essential, especially if you play fantasy football like I do. In short, Disney should not be tarred with the same broad brush as Netflix. Stock's actually back down to where it was before the launch of Disney Plus, so you're pretty much getting the streaming service for free. Look, it was okay to punish Disney for spending $71 billion to buy Fox in a massive overpay, but that's now in the rearview mirror. It was not the fault of current management. I know CEO Bob Chapek's been in a tough spot politically, but I'm giving him a chance. I bet he'll create value from here. And at these prices, I'm telling you, I think Disney's going to work. That's exactly why I bought more for the Chapel Trust. And by the way, you know what my plan is here? I'm going to keep buying on the way down. Sometimes good companies' stocks go down. I'm going to be a buyer. And there's more, like Procter & Gamble. Today, the Consumer Product Titan reported a number that was instantly panned because of the raw cost explosion, up more than $2.5 billion in a single quarter. Oh, sure, that's worrisome for sure. Definitely. But because Procter has some of the finest brands in the world, it was able to pass on those price increases at will. Procter is the classic stock for this moment. It makes things at a profit while being one of the great returners of capital with a stock that's got a pretty reasonable valuation considering its status as a dividend aristocrat. The fact that Procter was sold down the first half hour of trading shows you, once again, that many traders just don't know what works and what doesn't in this new environment. I should tattoo this on their foreheads. They assume that a company with big raw cost increases is a company that will have low margins and less opportunity to return capital while suddenly going from cheap to an expensive valuation. Procter simply doesn't fit that pattern. They can pass on their cost to the consumer, so there's no problem. Hence why the stock ultimately finished up 2.7%. Same goes for Johnson & Johnson. Yesterday morning, the company reported a mostly in-line quarter, except for the previously struggling MedTech division, which is great. J&J had been telling us that once COVID was beaten, people would go for elective surgery again, and their medical device sales would bounce back. That's exactly what happened. J&J's MedTech sales actually ballooned. That was a growth that gave you 4 times what I was looking for. Yet almost immediately, the stock started plummeting. By the time the CFO talked on Squawk Box, it was down $6. However, what is J&J? It's the ultimate blue chip company with the best balance sheet in America that has an amazing dividend buyback. It's a company that's splitting itself into 3 enterprises to unlock value, with the laggard MedTech division suddenly soaring. J&J was an incredible buy on that pullback because you now knew that the once broken third leg of the stock was now in great shape. Sure enough, the stock ultimately rallied 12 points from those lows. Boy, you can make a lot of money in a day off stupid people. And of course, like Procter, J&J is the ultimate dividend aristocrat. They're addicted to returning money to their shareholders. I'm going to give you one more because you know the universe is a lot bigger than people think. Morgan Stanley. Now, here's a company that does stuff, taking care of wealthy individuals and businesses, and it's got a stock that sells for 12 times earnings, so it's inexpensive. It's buying back stock. It's paying more than 3% yield. What more could you ask for? Morgan Stanley is the bank that arguably performed the best, as well as maybe best Bank of America. They were the 2 standouts. It's got a great CEO, James Gorman, and yet the stock's price-earnings multiple is shrinking, even as the Fed is raising rates, something that instantly makes their business more profitable. Morgan Stanley's down nearly 8% for the year. It's almost $20 from its high. Makes no sense. We bought some last week for the Charitable Trust. I'm itching to buy more. Okay, there is one stock in the entire universe that I follow that doesn't fit the funnel, and that's Tesla. It's real expensive. It's not returning cash. But it reported still one more outstanding quarter tonight, and its strength as well as its brilliant and tenacious CEO, Elon Musk, cannot be denied. I say, bravo, Elon. You are the greatest wealth generator in the world. You are, as we say, sui generis. And go get Twitter, will you? The bottom line, as someone who thinks it's a good idea to stay in the market, I'm urging you to consider companies that fit the funnel. This is the bull funnel, okay? While avoiding almost anything else than almost being Tesla, because it'll just make your life miserable. It's not that tough a prescription, but it's the one that works while we work our way through the Fed's aggressive tightening cycle. I want to go to Dan in Connecticut, please. Dan.
Hey, Jim. How's it going?
I am doing well, Dan. How about you?
Oh, living the dream, living the dream. What are your thoughts on Royal Caribbean with COVID fears settling and summer right around the corner?
Well, I got to tell you, I'm still partial to Norwegian Cruise Lines. Frank Del Rio's doing a great job, and at $22, I think that represents the bargain in the group. Let's go to Mark in Iowa. Mark.
From a founding member household, good health and booyah, Jim.
Thank you. Booyah back.
When a stock price goes down, dividends can follow. Dividends can go down too. I would like your opinion on the dividend safety of a particularly vexatious club stock. It does not look like it will return to its previous highs anytime soon. Should it still be a hold for a safe 4+% dividend, AEO?
Okay, American Eagle, Look, I do not want to say that it was a good pick. It was not, okay? I do think that Matthew Boss came on the other day, and he's the retail guru from J.P. Morgan, and said he thinks it's going to be fine. The balance sheet is good. The stock is too cheap. Excuse me, and that's why we bought some today. Now, I reiterate, we have not done a good job in AEO, but I don't want to give up on it. I think that's fair. How about Harriet in Florida? Harriet.
Hey, Jim. Jim, I'd like to know your outlook for Salesforce. Can it regain any of its, previous luster, or is the current price where it ought to be?
Well, I'll tell you, excuse me, this is a tough one because we've liked it since it was at $8. We've owned it for the trust forever. We did trim some. It's come back down. It's tempting, but we want to see the quarter. So does that sound like a ringing endorsement? No, we've owned it for a long time. We're going to continue on. How about that? We like Benioff, we like co-CEO Brett Taylor, and we are just willing to go along for the ride because that's what we've done since $8. That's when we first got involved and liked it. All right, please find companies that fit these characteristics, okay? It's just the plan that works while we work our way through the Fed's aggressive tightening cycle. Boring, prosaic, works. We made money tonight. We mentioned Netflix. It had zero chill today. I'm breaking down what today's drastic decline could mean for the future of the streaming service. Then all eyes are on inflation. But where could it be headed? I'm going off the charts to find out. And Halliburton's got dragged down today after earnings. But could this just be due to pin action in the oil service space? Or are there issues with the underlying company? I'll give you my take. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.